Look at the sheer scale of the British Columbia housing market. To buy a standard home here, a typical down payment now routinely breaches 6 figures, creating a steep mathematical barrier for even the most disciplined savers. There is a specific, government-designed sequence pairing the first home savings account with the RRSP Home Buyers Plan that allows a single buyer to recover up to $100,000 in tax-advantaged capital. While a high income is a prerequisite in this market, many buyers lose years of momentum because they save that income inefficiently. They fail to access this capital because they deploy these specific accounts in the wrong chronological order. Mastering this multi-year sequence determines who successfully closes on a BC property and who remains trapped in the rental cycle. The First Home Savings Account, or FHSA, is the highest priority vehicle in this timeline. It provides the unique benefit of tax-deductible contributions paired with completely tax-free withdrawals for your purchase. This chart shows the framework. You can contribute up to $8,000 per year, stacking blocks to a $40,000 lifetime ceiling. Open this account at the age of majority. Doing so triggers carry-forward accumulation, meaning your capacity grows yearly even without deposits. For buyers earning above the $53,000 provincial tax threshold, maximizing FHSA contributions is the priority. At this income level, the tax deductions provide the highest immediate return on every dollar saved. If your income is currently below that $53,000 mark, the optimal move is to contribute now but defer claiming the tax deduction until you enter a higher tax bracket in a future year. Establishing the FHSA framework on day one creates a compounding advantage. It ensures that as your salary grows, your ability to shield that income from taxation is already in place. Once you have maximized your annual FHSA room, you move to the secondary capital pool, the RRSP Home Buyers Plan. This secondary reservoir represents the HBP. You can withdraw up to $60,000 from retirement savings for a first home, but there's a critical timing requirement. Capital must remain in the RRSP for a strict 90-day holding period, or it becomes taxable. These funds function as a zero-interest loan from your own retirement savings. You are required to systematically repay the withdrawn amount into your RRSP over a 15-year period. Stacking a mature FHSA with a fully funded HBP gives a single buyer access to $100,000 in capital. This strategy recovers funds that would otherwise be lost to income tax and place them directly into a penalty-free down payment block. In the final months before closing, the strategy enters a final friction point. This is where buyers who haven't tracked their dates accidentally trap their capital. Last-minute deposits made in the same calendar year as your purchase are risky. If you don't account for bank clearing times and that 90-day RRSP lock, your cash will be frozen when the notary calls for the down payment. This timeline maps a successful closing. Initiate your qualifying FHSA withdrawals at least 30 days before possession. Simultaneously, HBP paperwork must clear the bank and legal phases, so both fund sources converge at the notary exactly on closing day. Managing these parallel timelines ensures your tax stack arrives for settlement without delays or administrative penalties. The federal government designed this dual account framework as a specific roadmap for accumulation. It rewards buyers who have the patience to adhere to a multi-year timeline with a significantly larger capital pool. A buyer using this sequence effectively bids with their gross income. They have a distinct advantage over those using what is left over after the tax department takes its share. To find your starting point, you must evaluate your current income level against your intended purchase date. For a custom analysis of how these numbers apply to your situation, visit silentstory.com or leave a comment with your income and purchase timeline below.